Okay. Duncan, you have a fancier office than me. You got all the nice artwork, but
Borrowed office today.
but as I was saying, I'm going to try to go through this. A lot of it we've heard before, um, so I won't bloviate. The case for gold stocks. This is a great 2025 blow off peak and the great rotation. Those are the themes. And this is near and dear to my heart. I think that Jesse Livermore once said, I never learned anything in making money. I learned everything in losing it. And I had a very successful hedge fund and career in the 1990s and got out at the top. But after the top occurred, I failed to look to new markets. And anyway, this particular chart shows how in 5 months I had a hedge fund which was up 112%. Mitch was a advisor at that point. It actually was 25 million at its peak, or 24, so it actually moved the needle. The problem with the market, and I've been saying this for a while, is I think it's grossly overvalued. One of the best valuation measures, I think, is the risk premium model, or the Fed model, which takes the earnings yield of the S&P 500 and it compares it to the 10-year U.S. Treasury. It turned negative. I called it the red zone, but now the stock market's pulled back, and so it is not quite as overvalued. But once you get a peak, I think then, you know, you're in trouble and we're still overvalued. I mentioned this a couple of weeks ago, and I said historically, when you break the 200-day moving average on the S&P 500, a lot of risk managers, institutional money, get negative. And then, we clearly broke it. And now we have got what is called the cross of death. And Here we go. And that just happened this week. And when the 50-day breaks below the 200-day, usually you've got to watch out. I think that this particular market reminds me a lot of the 2000 bubble, and the Magnificent Seven being emblematic of the dot coms. And I think I point to this earlier chart here of the 2000 bubble, and these huge companies all went down. And it's interesting when you look at the list, like AOL and AT&T and T, and but the point is 80% downside would not be surprising. I think the other theme that I like to think of things in terms of fundamental factors. Interest rates were declining for 40 years, or from 1981 till 2020, and then they've moved up. And then we've also had a bout of inflation. So no inflation or declining inflation with declining interest rates really helps stocks, bonds, and real estate. And there are other assets, hard assets, commodities in particular, that tend to do well when you have inflation. I think we're in that kind of inflationary environment. And generally during that period, you don't want to be in stocks and bonds, and you want to be in commodities. And one other place that tends to do well after the market peaks historically is the emerging markets can show great value. We saw a lot in 2000 going into China, and in the next 7 years, I think it was up sevenfold. But right now, I heard somebody say recently, like 70% of the U.S., excuse me, 70% of the global capitalization of the world is made up in the U.S. But when you think about the size of its addressable market, um, we're way overweight, the U.S., and looking abroad makes sense. And, which ones, I know Tony Lobier very accurately identified Argentina a couple of years ago when it was very cheap. It still has a very low CAPE ratio at 1. And I think that, some of these other places, you want to buy value in this environment. The question is, people will say, oh, you have to be in equities for growth. And I tend to think that that makes sense over the long term, but you don't have to be in the U.S. equities. And I think that that's really the takeaway here. And what I happen to like right now is gold. And I'm not sure whether everyone can see this well, but this is the price of gold, and everyone knows it's been going through the roof. It got to 3,300 recently. This is a GLD ETF. But down here, you actually have the uh, GDX, which is the gold ETF, and the GDXJ. And those have not gone up. And to me, from a financial analytics standpoint, if the price of gold is going up, your prospective earnings are soaring. And to me, we spend a lot of time looking at stories, trying to understand, what's happening with the company and how the story will get better. And the gold market has really been left for dead. And we can discuss that later. But a good example of that is the junior gold miner ETF, which currently is about one third of where it peaked in 2011. So it's down about 66%. And what has the price of gold done since 2011? It's gone up. So I really think that there is opportunity in the junior gold miner space. A group that I like called Crescat Capital put this chart together. I'd like to get an updated version, but basically the cash flows projected on gold miners is soaring, and we're not seeing the movement in the GDX or gold stocks in general, but we should start seeing some earnings get reported shortly that I think are going to drive things a lot higher. I think that the broad picture is that we went through 4 decades of declining interest rates, which were very helpful to the traditional asset classes I previously mentioned. But I'm not sure that they're going lower. And right now, that's very much up in the air. I mean, are we going to get inflation? And if we do, then that's a problem. And with a strong economy, then we could see 5%, 10-year treasuries, which would be bad for stocks. On the other hand, we may get a recession. So, certainly, we would like to see, the 10-year treasury at 3.5 or 3%. Certainly, that's what the administration or Scott Bessent is talking about. This is me. Somebody said, "What are you going to talk about? How right you are?" I don't know whether Hamid's on, but I will say that on our February letter, I said by several measures, this letter will show how the U.S. stock market is in a bubble and prone to a collapse. And so if you haven't read our letters, or you don't, from time to time we get them right. And since I certainly hear about it when I'm wrong, I'm glad to say right now it feels like the wind's at my back. And I said yesterday on a Zoom call that I feel like Rory McIlroy, the guy who had, after showing some talent years ago, finally won the Masters. Anyway, without further ado, Mitch, it's set up for multiples. Mitch Balajic has worked for Singer, Elliot, excuse me, Elliott Singer. No, what is it?
Paul Singer, Elliott Associates.
Okay, so I conflated the.
Okay.
Anyway, he's worked for some world class hedge funds and a quantitative analyst, and does AI work and is integrating all that. And so, what are you seeing?
Uh, a lot and nothing, but let me just start with just a few comments on the tariffs and the dollar. Um, Not getting into detail, but just pure price observations that seem to be very interesting. Um, there was a big confusion recently when the yields were tanking, but also the dollar tanking. So there was like a confusion. Was there change of regime or whatnot? Actually, this is something that's been happening before. It's nothing unusual. Typically, this move was really resembled by liquidity. Like the US dollar and the bond market is the global liquidity. And so the financial stability heavily relies on the US dollar because of the dollar dominated debt, another reason. So when there's a little bit of caution and of worrying about the US economy, just like we had in 2019 before the COVID crisis, then this liquidity tends to pull out, which means unusually, but many times in history, both the yields and the dollar go down. That's what we're seeing now. But if you look what happens after the worry, very often, just like now, comes the actual panic or recessions or whatnot. So if we are at a high risk environment, then the chances are that if we saw the dollar go down 4 or 5% in any type of growing panic environment, it will retrace back 10%. And this is exactly what happened in 2019 when it went down for that same reason, and the yields were going, the yields were actually moving up. But and then in 2020, with the panic and the COVID, the yields really surged. The yields really dropped a lot, and the dollar actually went way to the stratosphere. So I think that's what's happening now, and I think this is misleading if people think that this is the end of the dollar. If we get into any crisis, dollar is going to have a major rebound because this is still a dollar debt-dominated market, and generally a dollar financial market that requires dollar stability to function properly. So that's my take on the dollar. So I will be very skeptical of shorting it now. Any signs of recession, any other signs of this tariff wars going sour, dollar is going to have a major move to the upside, and that's going to also, which will cause a lot of short squeezes as well. Two other things I just want to mention. Last time I was talking about, I was really focusing a lot on stagflation picks, like what stocks and sectors would do well in a stagflation scenario. Maybe it is, maybe it's not a stagflation scenario, but generally in any negative scenario, there are certain stocks and sectors that would perform pretty well. And one of my picks is actually a fertilizer stock, NTR. I think this is like an excellent stock, and I'm following it. I think this is one of the best premier, way over undervalued defensive stock that do actually very well in these type of stagflation environment. Not to mention that anything related to commodities and food is going to have a big inflation hit as well. Then I was also talking about AI and my picks for 2025. I was moving from just Gen AI to like robotics AI, more manufacturing applications. And from the robotics part, one of my favorites picks was actually, I was really focusing a lot on small cap robotic stocks. They're going to do actually really well. And my type pick there is the Vicor Corporation, ticker VICR. They're like a power systems for robotics and data centers, and they're pretty much doing everything right. And they're in every field is going to show growth and do very well in this kind of environment, especially if we see this CapEx boom related to the AI robotics in the manufacturing sector. The other two things I was looking at, I've been following closely the energy sector, and my idea of the crude oil in general is to short any rally, and shorting rally meaning really selling the volatility, because implied volatilities with crude oil are incredibly high. So my preference of shorting is writing bearish call spreads or bearish iron condors more than the price itself, because volatility is incredibly high, unusually high. And combination of price move and volatility, it should get at least one of the two right. But the stocks that have been looking at very interesting is Occidental and Devon Energy. They have earnings coming up, and both of these stocks are way undervalued comparing to their peers. Fairly solid companies, and I think they're going to have in early May significant positive earnings surprises. So I'm not confident of going along the energy sector in this environment, especially that I'm prone to short the crude oil. But these are earning plays that should be watched closely, and that's kind of my take on it since our last call.
All right, that sounds great. Cheng Q, you were in China recently. And I told people here on the call that you are an analyst who I found on First Call in about 2003 at the depths when they started talking about nuclear winter in uh, tech land after the dot-com bubble, and every firm on Wall Street was was going to sells or dropping coverage of the stocks that you were recommending buying, and they were NetEase, Sohu, Sina, and I don't know, maybe Baidu. I don't know. I forget what the fourth was, but I bought them, and they went up. And your assessment was accurate, and ultimately they went up 100x. Now, being Chinese and speaking Chinese, studying nuclear energy or whatever at Columbia and business, you later went on to a hedge fund and a private equity firm. But you recently were in China. What are your thoughts there? Can you bring us up to speed?
Yeah, thanks, Tyson. I think the time is very different, from some 20 some years ago. At that time, China just, get into WTO, so the trading, the economic growth was all growing rapidly. Allow, 20 some, almost 24 years later, 20 some years later, the situation now is totally different. At that time, China and the US, they are kind of very friendly to each other. Now you see the change over time. In last President Trump's term, they even have some, negotiation in terms of trade. And then by President Biden's term, they characterize China as a strategic competitor. Now, if you look at what President Trump is talking about in his Twitter, he basically treats China as the adversary. So basically, it's kind of like enemy number one. So I mean, the last 20 some years, the macro in that sense is totally changed. China in Americans' eyes is no longer a friend, is more likely is an enemy. So that's a big problem in terms of investing in China. Since April 2, the reciprocal tariff get announced, and then everybody know now U.S. basically increased the tariff on China imports to 145, increased by 145, and China basically increased that by 125%. But essentially, the trade between these two countries will be right now. Though the effect is not there, but people already reporting, factories are closing. People have there is low order flow between the two countries. So the effects will be will be felt in the next few months. Now the problem is both President Trump and Mr. Xi Jinping, or China's leader Xi Jinping, they are both kind of like strong hearted people. They care about their own face than saving their own face than people's suffering. So in a sense, I don't know when they are going to negotiate down the tariff rate or some of the measures. I don't even know how high, or in terms of other measures, how high they will go to be against each other. So right now, I think I'm very cautious in terms of investing in China, because if you watch Secretary Benson, he even mentioned the other day, said all the China listed names in the U.S., delisting them, that's on the table. He's not saying that's not on the table. That's on the table. So which means all the names listed in the U.S. can be get into them can be a big risk. Can be at a big risk. On the other hand, if you ask me, say, push some put a baseball bat on my near my head, say, what do you do? I would think China, by then they won't sell U.S. Treasury. I think that's too big a measure for them. And the U.S. probably won't delist the China names either in terms of eventually. But getting to there will be a bumpy road for the next few months. Because they Xi and President Trump, they all want the other party call him, not he reach out. They basically they want to save their face than care what the economy is suffering. That's not their what they are thinking at the moment. They all want to show their strength.
Thank you. So my assessment is it'll be a great buy when we start to see some thawing, and that hopefully there will be a positive opportunity there. But I think that there are other emerging markets which are also attractive. Let's hear
one green shoot. Let me just mention that yesterday China basically changed their trade rep. The earlier one, that's from what I heard. The earlier one more a fighting wolf. The newer one is more a gentleman. I mean, it's gentler than him in that sense. Hopefully, that's a good sign.
Okay. Charles Zhang, you run some quantitative money and have worked for a couple quant shops. Are you still there?
Yes, I am.
Why don't you tell us? We understand your camera doesn't work, but just give us your quick take on what you think, what you'd be doing. Frankly, I'll reiterate. You guys made a lot of money, or you made a lot of money for your clients back in November, owning MicroStrategies and Tesla, got out of them, and basically have been in cash for a couple months. And you're using this post-earnings announcement drift strategy. Tell us what it's telling you now, and are you inclined to put your toe in?
Sure, of course. I just share my screen.
Yeah.
You can see it now, right?
Yes, we can.
Okay. So it's been about like 3 weeks since my last update on my quantitative strategy, and I want to provide a brief follow-up on where things stand right now. So consistent with my last update, the portfolio is still almost entirely in cash. My risk management framework continued to indicate the current market environment is not conducive to deploying capital in our loan-focused strategy. As I mentioned in last time, I'm waiting for key changes in market character before re-engaging. One of these was seeing the major indices like the NASDAQ repair their longer-term moving average.
Well, that doesn't look like that's happening anytime soon, but go ahead.
So specifically the 20-day, the 50-day, and the 200 days, indicating a return to a healthier trend. So looking at the NASDAQ right now, its key moving average remained firmly in a downtrend. So in fact, we saw a very clear example of this just 2 days ago. So the NASDAQ rallied to touch its 20-day moving average, but failed to break above it and subsequently dropped lower. So this action reinforces a key technical principle. So in an uptrend, these moving averages tend to act as support. In a downtrend, they tend to act as resistance, capping rallies. The second condition I talked about was the need to see a reduction in day-to-day volatility. So high volatility and choppiness creates like whipsaw that are detrimental to my strategy. I use the average true range, or ATR, as a proxy for volatility. A high ATR indicates a more erratic price swing. So as you can see down here, currently ATR remains significantly elevated, like running far above its long-term average. So this confirms quantitatively that the market is choppy, and its choppy and volatile character is likely to persist, increasing the risk of premature stop outs. So this brings me back to why I operate this way. So my strategy relies on explicit stop losses. So this is a philosophical choice to remain in control. In volatile market like this, the temptation might be to remove stops or widen them excessively. However, by not having a predefined exit point based on price, you're effectively giving up control to the whim of the market. And the market, as you know, is prone to unpredictable and sometimes maniacal episodes. So I think ceding that control is a very irresponsible risk management. So I'm not leaving my portfolio downside to chance. Since I cannot control the market, but I am in control of my entry criteria, my risk management, and also my response to outcomes. So with an asset demonstrating resistance at key moving average and the volatility remaining very high, my choice to use explicit stops makes me that I must wait for a condition where those stops are less likely to be hit by noise and more likely to represent a true trend change. So right now, I'm continuing to monitor for repair the moving average, a significant drop in volatility towards normal level, and the emergence of new market leadership. So until then, preserving capital is my top priority. Here are some examples that I showed last time of the past bear market. It just shows like how long these choppy conditions can last. So typically they last around 6 to 9 months at least, based on these examples. That's all I have right now. I'll hand over to Tyson.
That's great, Charles. I really appreciate it. What you'd said previously, I think, is worth reiterating, and that is using stops is a very good way to manage risk. I should have done that throughout my career. Uh, don't laugh. But what you said was in high volatility periods, such as what we're enduring right now, that using stops leads to your hedging strategy being very expensive, and so it just doesn't make any sense. So rather than try to operate without a net, you're just out of the market entirely. Um, anyway, let's hear what Tony Lobier has to say. You need to unmute yourself. Tony is somebody that's part of the Brimberg lunch group, and Tony used to be a analyst over at Neuberger Berman and did some work in minerals and mining, and has always been a astute trader. Tony,
Look,
I
I'm
can't see you. Hold on a second. That may be me. I don't know. Well, go ahead. Keep talking.
okay. Look,
There you
I remain very negative because I think this whole tariff policy is somewhere between misguided and insane.
go.
And I think the whole idea that you're gonna bully the rest of the world into changing the terms of trade isn't going to work, and it's going to push a lot of countries closer to China. Now, the other thing is, I mean, you've seen lately that this latest example with NVIDIA and their G20 chips. NVIDIA designs these G20 chips so to be compliant with US regulations. And then one day Trump comes out and he says, sorry, you can't sell these chips to China anymore. Now, the problem with this is that you have a few episodes like this and nobody can plan anything. And if businesses can't plan, capital spending is going to go down. Costs to the consumer are going to go up. Consumer spending is going to go down. And, this does not have good implications for either the stock market or the economy. Now, I personally have had most of my money in gold and silver, but when I hear that the most recommended thing on Wall Street right now is gold and gold, that's not good if you own the stuff. I'm not selling, but I have to say that I don't feel like doing anything. I think I'm really concerned about the dollar because number one, if you have a massive reduction in world trade, which seems to be the end result of all these tariffs, that's very bad. That's bad for the demand for the dollar, because the main function of the dollar worldwide is to finance world trade. So my feeling is not very inspiring, but it's just wait. I have been bullish on China. I still am for the long term, but I'm really concerned that this thing is getting so far out of control that U.S. citizens may not be allowed to own Chinese stocks, just as they were not allowed to own Russian stocks a few years ago. So I feel like going on an extended vacation.
Maybe we should plan one together, because I think that, frankly, the takeaway here is we want to probably stay out of the market for the next 5 to 6 months and looking for extraordinary bargains, which we might want to put 5% of our capital into.
I'm thinking about putting part of my cash reserves in foreign currencies. Not necessarily because I think the dollar is necessarily going to crash, but I think it might. And, I think currency diversification is important given the level of volatility everywhere. And I mean, in conclusion, look, Trump is convinced that he has the aces and he's going to win this war. I don't see it that way. I think the thing is at best a 50-50 proposition. And the most likely eventuality is everybody's going to lose. And that's not a very pleasant scenario. Thank you.
Thank you. We're blessed with having a very talented group. We have about 15 people on, many of them money managers and many very talented people I've known. So forgive me if I'm not calling on you right away. But Frank Longman, you are a great one of the top technicians I know. Work with Frank Texera and run a quantitative. Well, you run a hedge fund up in Boston. Do you have any comments on the market or anything that's been said here?
Yeah. I wasn't planning on contributing, but just as everybody was speaking today, I was, connecting a couple dots in my notebook, and I think, on the gold trade, obviously the trend for physical is up. I think one thing that we miss if we're gold bugs is the fact that physical is outperforming miners by such a wide degree. And historically, that's not great, because what you're doing then is, if you're long physical and underweight miners, right, you're giving beta. And that's what this market's been about all year, right, is being long lower ball, short beta, right? So if you're long gold with a beta to the S&P of, zero point 0.2, and short gold miners with a beta of beta to the S&P of 1.3, you're giving beta. So that's actually a defensive expression, right? And as we're trying to figure out, like, can these gold miners really work, right? The function is, can gold hold up long enough for miners' earnings to start to mute their volatility, contract their beta, right? And then they become more attractive relative to other, domestic assets. So that's one thing that we're really conscious of. Can that function happen? And that's where you would really get parabolic bullish action in gold miners, right? Assuming a constant liquidity environment, right? The threat to this whole trade, in my mind, is what we saw in 2008, where liquidity dried up, miners got really wide or really cheap relative to physical, and then it took at least 6 months, 3 months post policy, for that trade to reverse in favor of the higher beta asset or the miners. So I thought that was that was important. And then when we're talking about inflation, deflation, and globalization and deglobalization in the form of restrictions on trade in the form of tariffs, right? One of the reasons why we were able to create so much money without creating inflation over the years, over multiple decades, was globalization, right? We were transferring to lower cost inputs, specifically labor. And if we're going to shut that down, then that equation changes meaningfully, where more money growth could actually create inflation that didn't happen when you had globalization as an opposing force. So those were the only two things I thought were worth saying that I picked up.
Thank you.
I,
Go ahead, Tony.
I'd like to answer one of your questions. And I think that one of the real problems with the gold miners is that the two largest companies have been great destroyers of shareholder value, and that's Newmont and Barrick. I think they're both terrible companies. And that has meant that they dominate the indexes, and therefore, because they have been such lousy companies, quack companies, I think that's a major reason why these gold miners have not performed. I mean, both of these companies it seems to me, if you look at them, are more interested in building empires than they are in creating shareholder value. And that's not what people want. Agnico Eagle, which I have owned from time to time, is a really good company. Some of the royalty companies are good companies, but they don't, none of these companies dominate the indexes. So yeah, that's my, I just wanted to offer that as a partial explanation to what's happening.
Walter, you got any questions, thoughts? Then Alan DeLugash and then Ed Finder. And you're on mute, Walter, so.
Then nobody will know if I'm wrong. Yeah, a couple of things to both Tony and Frank. Tony, you're negative as hell. The sentiment is mind-boggling negative as hell. So my sense is that there may be a lot of it already in. With gold. Yeah, gold is already starting to do, Frank, what you're saying you hope it does. My biggest position is Agnico, in gold is Agnico. And I've had it, I don't know, when I realized it's really the best company. They just had a massive cash flow, free cash flow in the last quarter. I mean, these stocks are, if you have the right ones, the other one that's had a huge run is New Gold, which also has a bunch of copper. And Tony, actually, recently, the people are recommending Barrick and Newmont because they're finally through most of their shit. Now, I haven't bought them, but it wouldn't, but big guys will. But I think, and as you say, I mean, the nervous thing about gold is that it's starting to move. But I mean, these things are moving, they're wonderful. I'm an investor, I'm not a trader. So I haven't sold anything. Interestingly, because of my focus in energy, which has given back a little here, but particularly gold, is I mean I've skated through this thing. My objective is to be in good companies and hold them for as long as I think they know what they're doing. Now I think we're all scared that this thing can go a crapper, but one of the things I recommend to everybody, and I've certainly beaten Tyson up on this, I think the guy that is doing the best job in understanding the fundamentals is Ed Yardeni. And for like $30 a month, you can get this thing he sells called Quick Takes. And he just did, and you got to pay more. I mean, I think I pay a couple of grand per year, but to see his whole thinking. But just this week, he came out. I mean, he does such great work, beyond just sort of economics, but obviously figuring out where our money is going. And he went down and listed the ways that, actually Trump is right with even the good guys and the amount that they are putting have been putting on, great places like the UK and what have you, the amount on the tariffs. Now, he's gone about this completely wrong. And as you know, it can kill us. But once again, everybody's negative as hell, and it's hanging in there reasonably, at least with the fundamentals. Part of my other stuff, I've got one, sort of what I consider my conservative portfolio. I've had Philip Morris since before it split up. And that goes back to, wow, I'm trying to think of when did they split it up, understandably, when the government came after them and they wanted one of the two to, get completely out from underneath the government. But I've had the damn stock for 30 years or something. I mean, this year or last year was up 24%. And, they go up and they go down. But I'm going to pay a fortune, and knowing exactly when to get in and when to get out, to me, doesn't make much sense. Is there anything more I can say to piss people off?
No, you haven't spoken politics, but we'll skip that for the moment. How about Alan DeLugas? You got any comments or thoughts or questions?
Well, I think in the current environment, looking at charts and things like that is something that I can't understand the value of, because we're in uncharted territory where we've got a president who is in a very permanent way messed up the international financial system. I get a lot of good information from my brother, who runs 12 factories in China, sells almost exclusively to Europe, has one relatively minor part of his stuff which he sells only to the US. And so I have an understanding of the way how tariffs work. I've written a bunch. I don't want to go into a lot of the details here on my taxpolitics.com blog. It's tax politics that ends in IX. But what's really going on here is what's going on here is even the people who say that Trump has not lost his mind and there was a real rationale for what he was trying to accomplish by getting the rest of the world's tariffs closer to ours, that we're being basically our assets are being stolen by China. If anybody had done a cost-benefit analysis, this thing is laughable. The damage that's been caused to the global system and to the U.S. In the last few months is far in excess of any benefit that was foreseeable in any way to happen. The thing that's really most disturbing to me is that Trump's not the problem. We know he doesn't know what a trade deficit is, that we have a president who's has no idea what a trade deficit is, can say in the same breath that I want foreign companies to invest in the U.S. and I want to reduce the trade deficit, doesn't even understand that they are two sides of the same coin. When they invest $100 billion in the U.S., that increases the trade deficit by 100. So the ignorance of our president, though, is not the problem. The problem is the ignorance of the unwillingness of the people who know better. Everybody from Bessent to Moran to Larry Kudlow to Steve Moore to Art Laffer. These people should have been, stating what they know to be the truth, and they're hiding. Either they're afraid of Trump, which I understand from a lot of people is the problem, but for whatever reason, they're not speaking out. My feeling is I agree very much with what was just said in the prior speaker. I haven't sold a share of anything. Ultimately, things will turn around. The lessons that I've learned are in the tech bubble, companies didn't recover. The companies that were all smoke and mirrors disappeared from the face of the earth, never to be seen again. But in the recession of 2008, those companies all came back. So the perfect thing to do, stick with the good companies. Don't try to time what's going on. To me, the biggest problem that we have is not what's going on today, but my biggest fear, and hopefully I'm wrong, the biggest fear is that the idiocy of this tariffs is going to, potentially screw up the ability to extend the TCJA, because there's just so many people are not going to want to be associated with anything that Trump says. And so we may not even get good legislation passed. It's destroying the midterms. It's not clear to me how a Republican can run in the midterms, because They either have to be pro-Trump, which is going to be a loser, or anti-Trump, which is going to lose him all the MAGA votes, and he's going to lose to the Democrats. And then what's worse is in 2028, you're going to have the same issue. The Republicans have nobody. You can't run a pro-Trump guy and you can't run an anti-Trump guy and hope to win in the 28th. So I think we may be looking at some really bad policy coming down the road. But so my optimism is not there, but I'm going to maintain the position of, just holding. I'm not adding to anything. Additions are all just going to be in wait and see money, but that's that. The one thing I will say that looks to me to be very strong, which I've stuck with through over the last 30 years, has been the MLP space, the infrastructure space. Very strong, great yields, not affected in a very significant way with all these tariff shenanigans. Earnings are going to be strong. They've taken a big hit, and now in some I'm doing some opportunistic buying in that sphere. But that's it.
That makes for a great segue because Ed Finder is going to speak as soon as he turns the unmute on. And Ed is somebody who's been investing in the MLP space for years and almost hired me in around 2012, 2013. A terrible tragedy that didn't happen because he had about 100 million under management. A very, very astute guy, and worked at Lehman and did a very interesting career. But Ed, long time. Tell us what your thoughts are on the market and MLPs, and we'll leave it at that. And anything else you'd like to chime in on?
Well, first, thank you. Can you hear me, Tyson?
Yep, we hear you loud and clear. Okay. You still haven't gotten a haircut.
What's a haircut?
But you still have the Rolls Royce.
All of them.
Okay, go on.
The last gentleman who was just on hit the right space, MLPs. And in that space, if you take a look at energy transfer and enterprise products, you really don't have to take a look at anything else. Those are the two strongest horses that you have out there. And especially at these prices, energy transfer, but both of them are showing great strength, great recovery, have the earnings. I know both companies extremely well, including the management. Very superior people running these companies who really know what they're doing and are working for the investor. Both have big yields and tax deferred, which is rather interesting. If you don't sell it and have it as part of your estate, it gets transferred at the current price, so there's no tax implication in case you do pass away, which I
That's
understand.
not likely to happen with this audience.
Yes, which I understand is not being considered by anyone on this call. First, a couple of other comments, just quick comments. Totally agree on Ed Yardeni. I think he's as good as it gets in that space. I don't think Trump, and I happen to know the family, thought this out very carefully, and certainly his advisors, some of them should be shot. This should have been targeted tariffs and not done with this broad brush, which you just have to back away from and look pretty stupid and put yourself in a weakening position, and especially with China. The market has always been a market of stocks. And there are stocks in this market which I think should be owned. If you want a backdoor play on enterprise products and energy transfer, you buy TYG. That is a very interesting, way undervalued stock right now. and it
It's a
owns.
closed-end fund trading at
Yes,
a discount to NAV, right? That's
yes, that is
Tortoise.
correct. So that's a backdoor way into it's the Tortoise Energy Infrastructure Fund.
And you can put that in a retirement plan because it's wrapped up in as a closed end.
You can own it anywhere you like. The as far as gold goes, my one play on gold has been, since I don't understand it that well and have never really liked the miners, and not someone who's intimate with the management of these companies. I played it through GGN, which is the Gameco fund, which I own at $3 to $3.05. It had an 11.5% yield, which to me protected my downside, which is the way I always try to address things from the mortician's point of view. Right now, I would not be buying the gold stocks. I think one of the gentlemen who was on the call who said it's on everybody's lips, to me, is always becoming a problem. So I think the easy money has been made there. I would rather not bet against the world coming to an end at this point, and don't think that will happen. So therefore, I'm just at best a holder, and if not, use it as a source of funds. As
All right.
far as
Well, we've had all
that's
the
enough.
talented speakers speak. Thank you, Ed. That was great. Any final comments? We're an hour. I don't like to run these things past. If not, I'm going to say goodbye to everyone. I thought it was a great call.
Thank you very much, Tyson.
Thanks, everyone.
Thank you.
Thank you.
Thank you.